If you're like most people, you want to save as much money as humanly possible in taxes. After all, the more you save, the more you can put towards your family, your business, and a new house, maybe a new car, paying off debt, you name it. But saving money in taxes requires specific knowledge that not everyone comes across in their day-to-day life. Because my goal is to always help you guys save as much as possible in taxes, I'm going to break down some of the absolute best strategies, the best tricks and loopholes that you can use to legally save a fortune on your taxes. But before I get into it, don't forget to sign up for the Tax-Free Wealth Challenge using the link in the description below this video. Okay, you ready to learn how to keep more of your hard-earned money? Let's dive into this video. Number 1, HSAs. HSA stands for Health Savings Account. An HSA is a savings account for people with high deductible health plans that they can put money in on a pre-tax basis to use for qualified medical expenses later. HSAs help you to save money in taxes because when you put money into them, it lowers your pre-tax income. Then when you spend the money on qualified medical expenses, you still do not have to pay taxes on the money. However, the benefits of HSAs goes even further than that. You can invest the money in your HSA and the earnings and interest from the investments you make are completely tax-free. So HSAs help you to save money in taxes in multiple ways, and that is why they're incredibly amazing. Number 2 is Commuter Benefits. Commuter Benefits are specific tax benefits that the IRS allows for you to take advantage of related to your commute to work. For 2023, you're allowed to spend up to $300 per month tax-free on commuting. So this translates to a tax deduction of around $3,600 for the year, which is quite significant. A lot of people do not take advantage of commuter benefits because they simply don't even know about them. The $300 that the IRS lets you spend tax-free per month on commuting applies to a wide variety of commuting expenses. These methods include buses, trains, Ubers, Lyfts, subways, parking garages, and parking meters. The way that commuter benefits work is that the contributions are transferred from your paycheck to your commuter benefits account with pre-tax dollars, just like with an HSA contribution. Just like with an HSA, your contributions will reduce your pre-tax income, thus saving you money in taxes. Considering the fact that commuters in the United States spend a whopping $8,400 a year to commute every single year on average, any commute-related deduction can help a lot of people reduce their tax bill. All right, guys, number 3 is FSAs. FSA stands for Flexible Spending Account. With an FSA, you can pay for certain qualifying medical expenses, such as deductibles, co-pays, prescriptions, medication, crutches, bandages, devices for your blood sugar. FSAs help you to save money in taxes because they can reduce your overall taxable income. But keep in mind, however, that there is an annual contribution limit for FSAs, and this is $3,050. And keep in mind that if you have leftover money in your FSA at the end of the year, it does not automatically roll over to the next year. You will have to check with your employer to see what the rules are for rolling over your particular FSA. But this is another way in which you can pay for medical expenses and receive a tax deduction. Number 4 is called Dependent Care FSAs, or DCFSAs. A Dependent Care FSA is very similar to a regular FSA. However, instead of using it to pay for medical expenses, you can use for it to pay for qualifying child or adult dependent care expenses with pre-tax money. And these expenses can include your preschool, nurseries, daycare, babysitters, nannies, after school, assisted living, and much more. This is another way for you to reduce your tax bill with money that you are already thus going to spend, turning it into a tax deduction. Let's jump to number 5, and probably the one that you're most common with, retirement plans. There are a wide variety of retirement plans with tax advantages. 2 of the most popular are the traditional 401k and the 403b. 401ks are issued by for-profit companies, and 403bs are issued by nonprofit and certain government agencies like public schools. Both of these employer-sponsored retirement plans are tax deferred, which means that you can contribute to them with pre-tax dollars. This lowers your taxable income each year of your career that you contribute to them, and you do not pay taxes on the account until you withdraw during your retirement. There are many different types of retirement accounts, and I'm not going to go through all of them in this video, but you can check with your employer to see which one is offered and choose the one that is best suited for you. Now let's jump into number 6, long-term capital gains. Capital gains taxes are taxes that are owed when you sell an asset for more money than you paid for it. Capital gains taxes commonly apply to investments such as stocks and bonds. However, they can also apply to other types of property such as real estate. These taxes are divided into 2 categories: short-term capital gains and long-term capital gains taxes. With short-term capital gains taxes, taxes are levied on assets sold within 1 year after purchase, and they can be as high as 37% depending on your income level. However, with long-term capital gains taxes, they're usually 15 or 20%, but they can actually be as low as 0% depending on your income. If you can hold on to some of your assets for longer than a year before selling them, you could potentially save tons of money by paying long-term capital gains taxes as opposed to short-term capital gains taxes. Number 7 is called gambling losses. This may surprise you, but roughly 60% of US adults gamble at least once per year throughout different methods, such as slots, blackjack, poker, horse races, you name it. But despite the fact that tens of millions of Americans partake in gambling each year, of course, not everyone wins. The good news is that gambling losses are deductible. And that's right, if you have a wild night at the casino and you woke up to $5,000 poorer from blackjack losses, you might be able to write off those losses on your tax return. However, it is important to keep in mind that gambling losses are only deductible to the extent of your winnings. So in other words, you cannot deduct more than what you made from your gambling. Now, let's go over an example of the gambling losses, because I like to do this one to make sure that everyone understands. So for example, let's say that you won $10,000, but you lost $17,000 gambling in a given year. In this case, you would be able to deduct $10,000 from the $17,000 of total losses you had. This is because you only had $10,000 in winnings. So you would essentially wipe out your tax bill, but this negative $7,000 in gambling losses would not be able to be utilized on your tax return. So if we subtract the $10,000 from the $17,000, we get $7,000 left over. This means that you would have $10,000 in deductible losses and $7,000 in non-deductible losses. In this case, even though not all of your losses would be deductible, it is still extremely helpful to be able to deduct such a large portion of them. Just remember, if you're going to deduct gambling losses, then make sure that you keep receipts, ticket statements, and any other relevant documents from the establishment that you gambled at. And this can help you prove your winnings and your losses when it comes tax time. If you are ever audited, you will need the documents that prove that your gambling deductions are accurate and legitimate. All right, guys, let's jump to number 8. Number 8 is called 529 plans. A 529 plan is a plan that is designated to help families save for education expenses. These plans are named after Section 529 of the Internal Revenue Code, which was added in 1996. 529 plans provide a number of tax benefits that help people save money, but the first is that the earnings accumulate in the plan are tax deferred. Qualified distributions from 529 plans are completely tax-free when you take them out for qualified education expenses. In over 30 states, contributions to 529 plans are eligible either for a state income tax deduction or a tax credit. So please be mindful of when you have children to look into setting up a 529 plan. Number 9 is called capital losses. Capital losses are losses that are incurred when capital assets such as real estate or investments decrease in value and are then sold at a price that is lower than the price that they bought them for. The IRS allows you to deduct capital losses. So if you experience capital losses for things like your stocks, cryptocurrency, or real estate investments, then you can get deductions for them that can help you save money on the taxes that you're going to owe. If you experience capital losses in your stock investments, then you should be able to clearly see the losses on your 1099-B form that is sent to you by your broker. Crypto losses can be harder to understand or keep track of because the crypto market is much more decentralized and not all brokers send out the 1099-B forms. But if you have crypto losses, then you can use them to get a capital loss deduction that can help you offset some of the gain that you had in the current year. And number 10 is the Augusta Rule. The Augusta Rule is a tax loophole that allows you to rent out your home for up to 14 days completely tax-free. That's right. That means that you can potentially earn thousands or tens of thousands of dollars with the Augusta Rule without having to pay taxes on it. This rule was named after Augusta, Georgia, when many citizens rented out their homes to tourists during the Masters golf tournament in the city that year. However, although the Augusta Rule is named after Augusta, Georgia, it can be used anywhere in the United States. So regardless of whether you live in Portland, Maine, or Albuquerque, New Mexico, you can use the Augusta Rule to make some sweet tax-free cash every single year. This is one that you should not overlook. Whether you're making $20,000 a year or $200,000 and beyond, the tax strategies I discussed today can potentially help you save a ton of money in taxes, so don't overlook them. Even if you don't end up implementing all of the strategies I went over, what I really want you to walk away from this video with is the fact that even if you just use a couple of these strategies, it can result in thousands, if not tens of thousands of dollars in tax savings. So at the very least, they are worth looking into. If you have any questions about any of the tax saving techniques that I mentioned today, then feel free to schedule a complimentary consultation by clicking on the link below in the description. Also, don't forget to sign up for the Tax-Free Wealth Challenge. In this event, I'll be teaching you highly advanced tax strategies used by the wealthiest of Americans to optimize their tax savings. I do not teach these tax strategies on my YouTube channel, so if you sign up for the event, you'll get to learn everything about these powerful strategies over the course of 5 days. It's right around the corner, so check that out as well, and don't miss out. You can also find a link to the Tax Alchemy course and a link to speak with my real estate tax team in the description. The Tax Alchemy course teaches you how to leverage the power of real estate to minimize your taxes every year, and my real estate tax team can help you with overall real estate tax strategy. So feel free to check those links out as well. Okay, guys, that's all for today's video. I look forward to seeing you guys at the Tax-Free Wealth event. Cheers.